Australia is one of the wealthiest countries in the world, yet it holds one of the highest household debt levels globally, over 180% of disposable income. At the same time, property prices have soared to over 8 times the average annual salary, and interest rates are climbing fast. Sound familiar? These are the exact warning signs that preceded the 2008 global financial crisis, and they're all happening right now in Australia. But here's the shocking part. No one's really talking about it. Could the lucky country be quietly heading for a financial disaster? Could your savings, your home, or even your job be at risk without you realizing it? In this video, we'll break down 10 critical reasons why experts believe Australia might be on the brink of an economic crisis, and some of them will genuinely surprise you. Stick around because what you learn today could shape your tomorrow. Number 10. Political uncertainty, policy gridlock. Behind every strong economy is stable leadership, but in Australia, political turnover has become a revolving door, with 6 different prime ministers in just over a decade. That kind of instability doesn't just make headlines, it makes investors nervous. When the leadership keeps changing, long-term economic planning takes a back seat. Big decisions get delayed, important reforms are pushed aside, and businesses, unsure of what policy might come next, start to hold back on spending and hiring. Think about it. Would you invest in a business if the CEO changed every year? Probably not. That's what Australia's political landscape has felt like. From inconsistent tax policies to shifts in climate and energy strategies, constant back and forth has made it hard for industries to plan ahead. And that uncertainty trickles down to everyday Australians, job seekers, homeowners, and small business owners, who are left guessing what the future holds. Even global markets are watching. When foreign investors see a country flip-flopping on major issues, they hesitate. That hesitation means less capital coming in, slower economic growth, and missed opportunities to strengthen the economy. Add to that growing public frustration and a lack of trust in politicians, and you've got a recipe for a deeper economic disconnect. The truth is, without strong, consistent leadership, even the best economic plans can fall apart. Australia has weathered storms before, but without clarity at the top, it becomes harder to steer the ship through rough waters. So what do you think? Is political instability the hidden danger we're ignoring? Drop your thoughts in the comments. We read everyone. And if you're finding this video eye-opening, hit that like button, subscribe for more no-fluff insights, and check out our other videos breaking down global economic trends. Number 9. Small business struggles. Small businesses are the backbone of Australia's economy, employing nearly half of the private workforce and driving innovation in every sector from retail to tech. But right now, many of them are barely hanging on. A combination of rising operational costs, weak consumer spending, and tight lending conditions has created a perfect storm for small business owners across the country. One of the biggest issues is skyrocketing rent. In major cities like Sydney and Melbourne, commercial leases have become unaffordable for many local shops and cafes. Add to that soaring electricity prices, supply chain disruptions, and the ongoing challenge of finding and keeping skilled workers, and you've got an environment where survival feels like a daily battle. Even businesses that weathered the pandemic are now facing a different kind of crisis, one that's slower, more drawn out, and harder to escape. Access to funding has also become a serious hurdle. With interest rates climbing, banks are tightening lending criteria, making it difficult for small businesses to secure loans or lines of credit. This limits their ability to expand, invest in new technologies, or even cover short-term cash flow gaps. And when small businesses can't grow, neither can the economy. Worse still, consumer confidence is plummeting. As Australians cut back on spending due to cost of living pressures, local businesses are seeing fewer customers walk through the door. Some have already closed their doors for good, while others are scaling back, reducing staff, shrinking inventory, or shortening hours just to stay afloat. When small businesses struggle, it creates a ripple effect throughout the entire economy. Fewer jobs, less innovation, and declining tax revenue. And if this trend continues, it won't just be individual business owners who feel the impact. It will be communities, cities, and ultimately the national economy that bears the cost. Number 8. Retail and consumer confidence collapse. Retail spending is often one of the first indicators of an economy's health. And in Australia, that pulse is starting to weaken. Consumer confidence has plunged to levels not seen since the 2008 global financial crisis, and it's sending shockwaves through the entire retail sector. Australians are tightening their wallets, cutting back on non-essential spending, and prioritising essentials like groceries, rent, and utility bills. This shift isn't just a temporary reaction, it's part of a growing trend fueled by rising interest rates, inflation, and stagnant wage growth. When people feel uncertain about their financial future, they stop spending. And when millions of people do this at the same time, it sends the economy into a downward spiral. Retailers, especially small and mid-sized businesses, are left with unsold stock, shrinking profit margins, and a growing fear of closure. Major brands are also feeling the squeeze. Even large retailers have reported lower than expected earnings, prompting staff layoffs, store closures, and aggressive discounting strategies just to survive. Shopping centres, once bustling with weekend crowds, are seeing reduced foot traffic and increasing numbers of vacant storefronts. Adding to the concern is the psychological effect of low consumer confidence. When people believe things are going to get worse, they act cautiously, cancelling travel plans, delaying major purchases, and avoiding risk. This behaviour reinforces the economic slowdown, creating a self-fulfilling prophecy that can be hard to reverse. Online retail hasn't escaped the downturn either. While e-commerce boomed during the pandemic, even digital platforms are now reporting declines in average order value and customer frequency. All signs point to a cautious, cash-strapped population bracing for tough times. In essence, when consumer confidence collapses, it doesn't just hurt businesses, it shakes the very foundation of economic growth. And in Australia, those foundations are starting to crack. Number 7. Climate-driven disasters. Australia has always been a land of extremes, but in recent years, climate-driven disasters have intensified in both frequency and severity, and the economic toll is becoming impossible to ignore. From devastating bushfires to catastrophic floods and prolonged droughts, the country is facing climate events that are not just natural, they're financially crippling. According to recent estimates, the 2019-2020 Black Summer bushfires alone cost over $100 billion, including lost productivity, infrastructure damage, and recovery efforts. These disasters hit multiple sectors at once. Agriculture suffers when droughts dry up crops and floods destroy farmland. Tourism takes a blow as iconic natural destinations become inaccessible or damaged. Insurance companies are under enormous pressure, with rising claims leading to increased premiums and even withdrawal from high-risk areas. And the construction industry faces delays and skyrocketing costs as it scrambles to rebuild communities. But the economic impact isn't just in the immediate aftermath. There are long-term consequences too. Local economies in affected regions often take years to recover, if they ever fully do. Small towns lose businesses, jobs disappear, and property values plummet. Governments must redirect funds from growth projects to disaster relief, leaving less room for innovation, infrastructure, or economic development. Moreover, the unpredictability of these events makes it harder for both individuals and businesses to plan ahead. Farmers don't know if next season will bring rain or ruin. Investors question the stability of long-term assets. Insurance becomes either unaffordable or unavailable. In short, the economic environment becomes more fragile with each major climate event. As climate change accelerates, so too does the cost of inaction. Without substantial adaptation and mitigation strategies, Australia's economy will remain exposed, not just to nature's fury, but to the growing financial burden that follows in its wake. Number 6. Declining productivity. One of the most quietly dangerous trends in Australia's economy is its declining productivity, a slowdown that has serious long-term consequences. Productivity is essentially the engine that drives economic growth. When workers and businesses can produce more with the same resources, wages rise, costs fall, and living standards improve. But in Australia, that engine is stalling. In fact, labour productivity has recorded its sharpest fall since the early 1990s, and that's raising alarm bells among economists and policymakers alike. So, what's causing it? A mix of factors. First, there's been a noticeable lack of investment in innovation and new technologies, especially among small and medium enterprises. Businesses are operating with outdated systems, struggling to compete globally. Second, the education and training systems aren't fully aligning with the skills the modern workforce demands, leaving gaps in digital literacy, trade skills, and advanced manufacturing capabilities. Workforce participation has also been impacted by population aging and a rise in part-time or casual work, which often delivers lower output per hour. On top of that, rising costs of living are forcing people to work more just to maintain their standard of living, but not necessarily more effectively. The danger is that low productivity growth limits wage increases. When businesses can't get more value from each employee, they hesitate to pay more. and workers feel stuck, unable to get ahead, even as the cost of everything rises around them. Over time, this leads to stagnation, both economically and socially. It also makes the country less competitive on the global stage. If Australia can't produce goods and services more efficiently than its peers, it risks losing investment, trade opportunities, and economic momentum. Declining productivity isn't just a technical problem. It's a warning sign that the economy may be slowly losing its edge. Number 5. Dependency on China's economy. Australia's economic growth over the past 2 decades has been closely tied to its trade relationship with China, a partnership that has brought in billions through exports like iron ore, coal, natural gas, and agricultural products. In fact, China accounts for nearly 1/3 of Australia's total exports, making it by far the country's largest trading partner. While this relationship has been lucrative, it also exposes a serious vulnerability: overdependence. The problem with relying so heavily on a single nation is that when that nation stumbles, you feel the shockwaves. And right now, China's economy is facing multiple challenges, including a real estate crisis, weakening consumer demand, and escalating geopolitical tensions. As China slows down, its demand for Australian resources and goods could drop significantly, directly impacting Australian industries, jobs, and national income. We've already seen glimpses of this fragility. When political tensions flared between Canberra and Beijing in recent years, China imposed tariffs and restrictions on Australian exports like wine, barley, and seafood, instantly hurting the producers reliant on those markets. While some trade ties have been restored, the message was clear: too much reliance on one customer puts the entire economy at risk. This dependency also limits Australia's policy flexibility. The government must tread carefully when making foreign policy decisions, knowing that one misstep could trigger economic retaliation. It's a delicate balancing act between economic needs and national sovereignty. Diversifying trade partners is easier said than done. Developing new markets takes time, resources, and infrastructure. But without that diversification, Australia remains economically exposed to the decisions and downturns of another country. In an increasingly uncertain global landscape, being overly reliant on China places Australia in a precarious position, one where a change in foreign demand could send ripple effects throughout the entire economy. Number 4. Stagnant wage growth. For many Australians, it feels like their paychecks just aren't stretching as far as they used to. And that's not just a feeling. Wage growth in Australia has been stagnant for over a decade, and when adjusted for inflation, many workers are actually earning less in real terms than they were 5 or even 10 years ago. This is a major concern, not just for individuals trying to make ends meet, but for the entire economy. Despite rising costs for housing, groceries, fuel, and essential services, wages have barely kept pace. While inflation surged following the pandemic and global supply chain disruptions, salary increases lagged far behind. This has led to a steady erosion of purchasing power, meaning Australians can buy less with the same amount of money. As a result, many households are dipping into savings or turning to credit just to cover daily expenses. One of the key drivers of stagnant wages is the rise of insecure and low-growth employment. The labour market has seen a significant increase in part-time, casual, and gig economy roles, which often offer fewer benefits, lower wages, and limited opportunities for advancement. Meanwhile, many companies remain cautious about increasing wages due to rising overhead costs and economic uncertainty. Another factor is weak productivity growth. When workers are not producing significantly more output, employers are less inclined to raise wages. Coupled with limited bargaining power for unions and employees in certain sectors, it creates an environment where wage growth is suppressed. The broader impact is reduced consumer spending. When people aren't earning more, they spend less, which slows down business growth and in turn limits job creation and salary increases, forming a vicious cycle. Stagnant wages aren't just a financial problem for individuals. They're a structural issue holding back Australia's economic momentum. Number 3. Rising interest rates. One of the most immediate and painful pressures on the Australian economy right now is the sharp rise in interest rates. In an effort to curb inflation, the Reserve Bank of Australia, RBA, has implemented a series of aggressive rate hikes over the past 2 years. While these moves are intended to stabilise the economy, they're also putting massive financial strain on households, businesses, and the broader financial system. For homeowners, especially those with variable rate mortgages, the impact has been swift and severe. Monthly repayments have jumped by hundreds, even thousands of dollars in some cases. Families that were already stretched thin are now struggling to cover their mortgage, forcing many to cut back on essentials or dip into savings. Mortgage stress is on the rise, and with more interest rate hikes possible, the financial pressure is far from over. But it's not just homeowners feeling the pinch. Renters are also being squeezed as landlords pass on increased mortgage costs. Meanwhile, small businesses face higher borrowing costs, making it harder to invest in growth, hire staff, or even maintain day-to-day operations. Every dollar spent on loan repayments is a dollar not spent in the real economy, slowing down consumer spending and business investment at a time when growth is already fragile. Higher interest rates also affect confidence. People become more cautious with their spending, delaying major purchases like cars, renovations, or holidays. This in turn reduces demand across multiple industries, from retail to tourism, and contributes to a broader economic slowdown. There's a delicate balance between fighting inflation and avoiding a recession. But if rates continue to rise without wage growth or cost of living relief, more Australians could find themselves in financial distress. And that's a risk the entire economy will have to bear. Number 2, housing market bubble. Australia's housing market has long been a point of national pride and concern. For years, property prices in cities like Sydney and Melbourne have skyrocketed, making home ownership feel like an impossible dream for many young Australians. But behind the headlines of booming real estate lies a deeper issue, the very real risk of a housing market bubble. A housing bubble forms when property prices rise rapidly, driven by speculation, easy credit, and fear of missing out, rather than genuine demand or income growth. And that's exactly what's been happening in Australia. In some suburbs, homes have doubled in value within just a few years. The problem? Wages haven't kept pace and debt levels have soared. Today, the average home in a major city costs more than 8 times the median annual income, one of the highest ratios in the developed world. Much of this growth has been fueled by low interest rates and generous lending, which encouraged buyers to borrow more than ever before. Investors also flooded the market, purchasing multiple properties in the hope that prices would keep rising. But now, as interest rates climb and affordability plummets, cracks are beginning to show. First home buyers are being priced out and demand is starting to soften. At the same time, rising mortgage costs are putting pressure on highly leveraged households. Some homeowners are now at risk of negative equity, where the value of their home falls below the amount they still owe. A sudden drop in housing prices wouldn't just hurt homeowners. It could trigger a chain reaction throughout the economy, affecting banks, construction, retail, and consumer confidence. Australia's housing market has become a giant balancing act, and all it might take is one small push, higher rates, job losses, or a drop in migration to tip it into a dangerous decline. Number 1. Soaring household debt. Australia is facing a household debt crisis that's quietly growing beneath the surface, and it could be one of the most dangerous threats to its economic stability. According to the latest figures, Australian households carry one of the highest levels of debt in the world, with debt sitting at over 180% of disposable income. That means for every dollar the average household earns after tax, they owe nearly 2. Most of this debt is tied up in mortgages, and with rising interest rates, the cost of servicing that debt is becoming increasingly unmanageable. For years, cheap credit and booming property prices encouraged Australians to borrow big, often stretching their finances just to get into the market. It worked while interest rates were low and housing values kept rising. But now, the tide is turning. Interest rates have jumped, home prices are starting to stagnate or fall in some areas, and repayment stress is setting in. Households are being forced to cut spending on essentials just to keep up with their loan repayments. This isn't just a personal finance issue, it's a systemic risk. When so many people are over-leveraged, any economic shock, like job losses, another rate hike, or a fall in property prices, could trigger a wave of defaults. That, in turn, would hurt banks, reduce consumer confidence, and slow economic growth. Debt can also act as a long-term drag on the economy. Households with high debt levels are less likely to spend, invest, or take financial risks, which stifles growth. It limits social mobility, increases inequality, and fuels financial stress across entire generations. The scary part? Many Australians don't realise just how exposed they are. As the cost of living continues to rise, this mountain of household debt is becoming more than just a burden. It's becoming a ticking economic time bomb. Australia has long been seen as a land of stability, a strong economy, high living standards, and a housing market that seemed unshakable. But as we've explored, there are growing signs that this stability may be under serious threat. From record-breaking household debt and a potential housing market bubble, to rising interest rates, stagnant wages, and an over-reliance on China's slowing economy, the cracks are becoming harder to ignore. When you add in climate-driven disasters, declining productivity, weak consumer confidence, struggling small businesses, and ongoing political instability, it becomes clear that these issues aren't isolated, they're interconnected. Each one feeds into the next, creating a fragile economic environment where even a small shock could have major consequences. This doesn't mean a full-blown financial collapse is inevitable, but it does mean that Australia is standing at a critical crossroads. The choices made by policymakers, businesses, and individuals in the coming months and years will determine whether the country can steer away from crisis or slip further toward it. What's important now is awareness and action. Recognizing these risks allows people to make better decisions, to manage debt more cautiously, support local businesses, push for political accountability, and prepare for the long-term effects of economic change. Ignoring the signs could leave millions vulnerable if the economy does take a downturn. Australia has overcome economic challenges before, but the nature of today's threats is different. They're slower, more complex, and deeply woven into the structure of modern life. And unless they're addressed with urgency and foresight, the lucky country might find its luck running out.